Okay, welcome. We're going to start the Zoom meeting now. We've got people in the room. We've got a lot of people on Zoom. So welcome, everyone. Thank you so much for coming. We appreciate your time and effort in learning perhaps something new. So anybody that has a question tonight, people that are in the room, particularly the people on Zoom, can't hear you. So what we figured out is on the tables here, you have notepads. And if you have a question, what I want you to do is write the question down and then give it to Christopher, me, Nicole, and then we'll answer questions at the end. And everybody that's on Zoom, if you don't mind typing in your question that you have, we will answer all of those at the end. Okay, just so we're clear on all of that. Okay. Again, welcome everybody. I love having these events. Tonight I have Jason Van Duzen here with us with BlueRock Capital Markets. We so appreciate him coming. I'll introduce him in a minute, but I want to go over a couple of slides first before we let Jason jump in and speak. Whoops, wrong way. Okay, so building foundations for financial wealth. That's what my series I call in all of these seminars that I do throughout the year. I do put a lot of these on the internet on my website, and it's under events. No, it's under previous webinars and it's under building foundations. It says on my website. I am going to have another building foundations for financial wealth seminar that is not product specific. That will be on December 5th. That will be on traditional investments. So investments that stocks, bonds, mutual funds, annuities. I do a deep dive in all of those. I have a lot of people, especially from the radio show and people in the room here, that ask me about annuities and are they good or bad? No, they're not good or bad. It depends on what you're looking for. So I'm going to do a deep dive in that, as well as stocks, as well as bonds, as well as mutual funds. So I think that'll be really a nice educational tool for a lot of you that need some more education in that way, or just maybe you have questions on all of that as well. So that will be on December 5th. I do have a couple of more seminars coming up, product specific, and I will talk about those at the end of the webinar tonight here. Okay, those of you that are new to me, yes, I do have a radio show. I know everybody in the room is familiar with that and found me through the radio show. KNX 1070 is my radio station. I play on Saturdays and Sundays. I have all of my previous radio shows on my website. So CaliforniaWealthAdvisors.com. You can find all of my previous radio shows. I got 2.5 years of radio shows on there. So by all means, go there and listen. At the title of each show, it lists a little bit about what we talk about per show. So you can kind of go through there and find of what's interest to you. I would direct you guys to the questions shows, because I have a whole show of just questions from listeners. I think that's really great and people love it when I do that. So anyway, there you go. Radio show. Love my radio show. Also my book, of course, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. This is appropriate for everyone. Yes, retirement is in the title, but it's true for it's a strategy. It's how we do things. And so that's, I think, good for everyone. And of course, how to avoid the 6 biggest blunders is good for anybody. I don't care if you're 10 years old or 80 years old. It's good for you. You want to avoid those blunders that I see out there. So that's something available for you too. Okay, let's talk about investments a little bit here tonight. So I want to encourage everyone that's new to me, everybody that's even in the room and been with me for a long time. I have Leslie here that's been with me for 30 years. But you need to have a plan, and you need to have a plan specific to you, because everybody in here, everybody on the Zoom today has different needs. They have different requirements. They have different assets. They have different income streams coming in. Everybody's completely different. So you need to make sure you have a plan that's designed for you specifically, creating a portfolio for you that's actually doing what you want it to do. Having diversification, of course, is the second component to investment that I like, because you've got to have diversification in your portfolio. Don't just have all your eggs in one basket, right, Al? We don't want to have everything in the market necessarily, because there's a lot of risk there, okay? And talking about risk, my master proprietary process is how I kind of show people how investments work, or why you should be diversified. So M is the market, stocks, bonds, mutual funds. Again, December 5th, that's when I'm going to have that seminar that we'll talk about that section of investing, as well as I've got some annuities in there too. That's the dark blue section. But it's red for a reason. Stocks go up and down. I don't have a crystal ball. I actually do have a crystal ball in my office, but she doesn't always tell me what's going on. And so long-term investing, this is not a sprint. When I have clients, when I'm talking to people, this is not a sprint. This is a marathon. You've got to weather whatever is going on, ups and downs in the market, particularly when you're invested in the red. Okay, we've got to weather the storms that we see. We monitor things. That's why we do portfolio reviews constantly with people and make sure they know what's going on with their portfolio. But you've got to stay invested for the long term. Have a plan and stick to it. The alternative section, that is kind of where Jason tonight is going to speak. It's kind of between the red and the light blue, if you will, because it is a real estate program, but you can get out of it every quarter. Every quarter they do offer liquidation. I'll let Jason go into more of that when he speaks. So it's kind of between the red and the light blue as well. I do a lot of seminars, as most of you know, in the light blue section. I do have a number of those coming up, and that I will talk about more about seminars when I get done here, when Jason gets done. And then, of course, the dark blue section, that's the safest thing I can do for you. Those are annuities. Those are fixed index annuities or fixed annuities, or even life insurance and long-term care is in that section as well. Okay, so that's the world of investing there. So with that, I'm going to bring up Jason. So Jason Van Duzen, very, very dear friend of mine, known him for quite a long time, Senior Regional Vice President for BlueRock. And he represents California, Nevada, any other states?
That's it.
That's it. He's got a lot to cover there. So we appreciate him coming tonight. Again, very dear friend of ours, knows a lot about the real estate realm, has really cut his teeth for many years in real estate. So he certainly understands that, and certainly is a great representative for BlueRock as well. So with that, Jason, take it away.
Thank you very much. Thank you, guys. For those virtually, I appreciate you being here. I do move around a little bit, so hopefully I'll stay within view of the camera here. So again, yeah, Jason Van Duzen, Senior Vice President at BlueRock Capital. Been with BlueRock since 2017, joined from a competitive firm. And yeah, represent Southern California, specifically in Los Angeles County, up to Central California, and then Las Vegas as well. Been in commercial real estate my entire career. So, and the whole thing that I concentrate on, and by the way, I grew up in this business. So I had a father that was in financial services for about 45 years and recently retired. So grew up knowing that I wanted to do this in my life. So we owned oil and gas companies and a lot of real estate stuff. And so I always knew eventually once I could get into the business, I would, and I'd go head and feet first. So anyways, I can tell you my whole role and what I do is this. So I typically am working with financial planners. I've gotten to a great point in my career that I only work with a specific type of financial planner and a specific number of them. So I've kind of narrowed down my base, and I can tell you, and Kelly did not slip me any monetary benefit for this, but I can tell you that Kelly is by far not only one of the top in Santa Barbara and Santa Barbara County, but quite frankly, one of the top in her entire firm. They actually have firms nationwide, okay, but they have a very elite group of advisors that you can count on two hands and some toes in the entire nation, and she's part of that very elite specific group. So you're working with one of the top financial advisors nationwide. So it's always an honor. Anytime that she says, "Hey, can you do something for me?" I kind of drop it all and drive up from Costa Mesa like you did. So more than happy to be of help. So anyways, at BlueRock, we have a lot of different vertical strategies. We're an institutional firm concentrating in real estate and also in credit. So one of the funds that we have that is our flagship product, if I was going to call it anything, would be the Total Income Plus Fund. That's what it's called. So I'll go over first kind of what's happened in the world, and especially as of last year. A lot of people want to go, what happened? How did we get there? Talk about the strategy that we have, and then of course kind of what we're doing, kind of the performance and how we've been able to be a benefit to investors. So last year was a very difficult year. So for those that are not aware, there's a portfolio model and theory called the 60-40. Have anybody heard of the 60-40 theory? 60% of the portfolio in stocks, 40% in bonds. It is one of those concepts that was created forever ago. And it was simply a concept saying, I don't care if the world's good or bad, you're going to make some money if you do a 60-40 model. Well, the problem was last year when we went through the rampant inflation, not the normal 2 or 3%, when you're at 8 plus, call it 4 times normal. When you saw the 30-year, think of mortgage rates. Mortgage rates they actually just eclipsed 8 the first time since 2000. Today, right?
It was today.
Today. Unbelievable. When you think about that, and we'll go over that in a little bit, but I mean, think about buying a home, what you could afford at, 3, you can't even get a fraction of that at an 8 if you're trying to keep the same mortgage, right? So it's priced out a lot of people. But anyways, the 60-40 model last year, you had the worst year. If you just had a basic 60-40, and luckily with Kelly, you don't. So you've got her math system and process. But if you had a basic 60-40 model, you lost over 16% last year. It was the worst performance in 100 years. If you just had a basic 60-40 model, and there was no place to hide. And that's quite frankly why the 60-40 model was created, right? If equities are bad and the stock market's bad, then at least I've got the bonds at 40 doing something for me to provide protection. Nothing was safe last year, guys. So when you look here, so you actually have bonds on average down 13%, down 13. So that's your safe money, if you will, is down 13. The S&P, so the basic stock, the top 500, down 18. And the NASDAQ, and which is what's the NASDAQ? Those are the big tech, right? Your FANGs, as they call them, the Facebooks, the Amazons, the Apples, they were down over 30. And even with the run lately that they've had, some of these companies are up like 50, 60%. You're still barely clawing out of the hole from last year. So you don't go up 30 to get back to hold, right? Got to go up a lot more than that. So all this is getting to the fact that what we did at BlueRock with our fund, we were one of the few, if only, glimmers of hope on a portfolio. We ended up, if you were in for the full year last year, you were up over 10% last year, positive. So the question begs, well, what are you guys doing? Foundationally, what is it that you're investing into that's really been able to kind of zig while the market zagged, right? Like how do you do something different? And the first, most important thing is that we invest in institutional private equity real estate. So let me break that down. So there are funds that are out there that are private, not publicly traded. Okay, private, not publicly traded. So you don't have the volatility on a daily basis like you do the stock market or stock, because those are publicly traded. These funds are not. So, and they're also institutionally formed, created, and managed. And what that means is there are major institutional companies out there, investment firms out there. To rifle off a few, Prologis, Morgan, Merrill, Blackstone, BlackRock, Clarion, Ares, Carlyle, Prudential. There's these whole host of institutional managers, and they do a lot of things. But one of them is that they create funds solely and exclusively for the pension world, like a CalPERS, if you will, or even an institutional world like STRS, CalPERS, CalSTRS, endowments like Harvard and Yale, very institutional pedigree. Minimums to get in are 5 million, 10 million, 50 million per fund. Typical investor puts in 100 million or more in at a time. So it really prices us out of the equation. And so they created these funds, and these funds have been around for 40, 50 years. These aren't new concepts, but it's just never been accessible to the retail client. And we wanted to find a way to be able to provide institutional investments for retail clients like ourselves. So why we like institutional private equity real estate is the track record is phenomenal. 45 years. The average just income from these things has been of almost 7%, not including growth, just income alone. And the risk-adjusted returns are phenomenal, which I'll go over with you. And then also just having these best-in-class managers and the opportunity to invest with these best-in-class managers is really what drove us. Now, this is the track record. This is my invest with conviction slide, is what I like to call it. Don't try to time things. Again, that's why you get the guidance of Kelly, because she knows these things. Real estate is a long-term play, guys. You can't time these things. You've got to invest with conviction, is what I like to always call it. It's look at the smooth and steady ride of institutional private real estate funds. If you put in 10 grand day one back in 1978, you'd be at almost $500,000 today. And there's only been truly 2 pullbacks ever in institutional private equity real estate. That sort of a track record is uncanny. You saw a time in the early 90s. Does anyone remember what happened in the early 90s? Savings and loans crisis, right? It was down 4% and 6% respectively, those 2 years. That was it. It then had a rocket, a nice smooth, I don't call it rocket, nice smooth ride up the hill. I call it, back of the rolls type ride up the hill. You then had really the first of a big correction and the worst, and that was 0809. We remember the great financial crisis, right? It was down 6 and then down in total 17% in 2 years. That was the worst. And then look, straight rocket to the up. You had COVID, which ended up positive for the year. Another, I always call the Elon rocket, rocket ship up to the upside. And so really since 0809, there has not been any sort of an instance to where it's paired off. It's been straight bull every single year, positive. And finally now what happened is that through here, and this is COVID, reminder, you ran straight to the upside in a very aggressive manner. There was so much pressure in a positive way if you owned the right real estate. Let me put it that way. If you owned the right type of real estate, and I'll go over that shortly, you saw a huge, uncanny growth to the upside. And it's a lot of it because of the pressure that was put on because of being stuck at home. And there were certain asset classes that benefited tremendously. Others, because of COVID, have really struggled. And I think it's pretty easy to understand which ones, but we'll go over them. But you've seen kind of a pullback. And I like to pull back right now. We're finding, and we feel that we're kind of in the troughing zone right now where we are here. We're getting there very fast. So it's a great opportunity for those that may not be in it to be able to start to look at the opportunity of entering into the total income plus. And for those that are in it, realize that you saw a significant growth. You saw years of returns in just 2. And I'd say right now, it's almost like a little bit of a settling period right now. You saw such what they call compression, such aggressive growth that it's kind of just letting a little bit of the steam out right now. And peak to trough in right now in these funds are down just a little over 10%, which is still, when you think about that chart that I showed you from last year, bonds down 13, that you're saying, to be only down that is to me a clear outperformance. And a lot of it is because of the uncanny nature of these things. This is just a basic 4-box. I'm not going to spend too much time on it, but this is a thing that Kelly and I, we constantly look at and spend time on. It's talking about high return to low return, low risk to high risk. This is the part of the 4-box you want to be in the top left, or in Seattle, if you will. Because that's a high return with low risk. Stocks up here in the top right with publicly traded real estate funds, again, publicly traded real estate funds are in what I like to call the Vegas money, high return, high risk. Down here is your, what I call the dum-dum money, that's high risk but low return. And this is your typically safe money, the low return but low risk. So this is the Dramamine ride that you would have been on if you were just in equities or publicly traded real estate funds in gray and green. Look at the volatility. And quite frankly, it gets to the point, in our opinion, in my opinion, publicly traded real estate funds are in gray, and in green is the stock market. Look at how almost in parity they are. They're not perfect. I always call it like a bad dance partner or something, but if you look at it, they're pretty close, right? I mean, there's certain instances where they're literally almost the same. I mean, it is as close as you can get, in my opinion. So it begs the question of why even do it? I would rather just be in equities, the stock market in green, right? And then maybe look at other untraditional ways, if you will, like institutional private equity, to where if you look at in blue, institutional private equity real estate funds has only seen 4 down years in 45. 4. They've seen a few more in here. And quite frankly, do you want that? And I find with most people that buy into this Total Income Plus fund, we raised over $7 billion of investor capital. We're number 1 by far in this space with a clear lead, that a lot of people don't want that. right? I want to take some of that volatility out, and that's why they buy into this. Some of the slides I may skip over just so they're a little bit more technical. So, and this is just getting to the fact that during what we went through last year, this is why you want to have institutional private equity real estate. So during times where like the 10-year treasury is going up tremendously, and this is just showing how institutional private real estate just clearly outperforms during these times. Same also during inflationary periods. There were a number of periods throughout the last few decades and 40-something years that we've seen considerable outsized returns, cumulative returns, and even annualized returns from in blue in institutional private equity real estate during those same times when rates were going up, both in the 10-year and the Fed. And this is just another way, without the Dramamine ride, to look at only been 4 down years. And by the way, when these were down 6 and 17, equities went down over 50. Which, by the way, when you go down 50, how much do you have to go up to get back to even again? 100. So these are things to consider. If I can take out a little bit of that 50, then that's the ultimate goal. You look through COVID. If you guys remember COVID from an investment world standpoint, Kelly and I do, we had intraday halts, opening day halts in the market, 2,000-point drops. Everything was breaking news. See you around. I mean, and to end up positive, then up over. We were up over 20%, and then up over 10% last year. So again, it's just been, these things have really been able to perform uncanny during times of distress, and that's ultimately the goal of this: is take out some of that stress of investing. The Total Income Plus Fund is the largest of all the real estate funds in the industry in regards to what we do, what they call interval funds, which is mutual fund structure, and it is the second largest of all the funds out there. So largest in real estate and second largest amongst all of them. So the strategy of this fund is that it's an income generating vehicle. It pays 5.25 is the distribution, 5.25%. So we want to be an income solve. The second thing is we're looking to be a tax solve for a portion of that income on a 1099 basis, about 65% historically, going on in 3 days. It'll be 11 years of us operating this fund alone. And it's been about 65% tax deferred on average annually. And then also we want to be in what they call an inflation solution or total return solution. Real estate's one of the only strategies really that can check all 3 of those boxes. Checks off for income, checks off for taxes, and checks off for total return or inflation solution. There's really no other investment that'll be able to check off like real estate can all 3 of those boxes. So this slide really addresses, in my opinion, not only is it the strategies, the multi-strategy, multi-manager, multi-sector approach, but it addresses some of the biggest fears, in my opinion, with investing. So what I mean by that is let's address each one. So multi-strategy. We have multiple strategies under this one investment. Okay. To me, if you only bought one investment strategy and God forbid something happens and that strategy isn't working, if that's the only thing you're doing, you're up creek without a paddle, right? That's a problem. So but by having multiple different strategies that we can, like a race car driver, get in and out of, and what they call tactically manage, having that capability to move is very beneficial. So taking what they call single strategy risk out is important. So we have a multi-strategy where the predominant portion of our fund is investing in those institutional private real estate funds that we talked about. That's like 90-something% of what we do. We have a very, very small percentage in publicly traded funds. We just don't like that, right? We don't like the volatility. So we like the institutional private equity of a very small amount as well, single digit, in what they call debt programs or note programs. We don't put debt onto our products. We don't take your money and turbocharge it like some do, but we invest in strategies that pay a high income and produce a nice income for the portfolio. So anyways, multi-strategy, multi-manager. So this is big too. We really focus on giving you access to the best-in-class managers out there and their highest rated funds. I always call, I do this a lot, so I always have these terms, and this is like the Rolodex that Buffett would blush at. Some of the best names in the business, like I said, AEW, Ares, Bain, Blackstone, BlackRock, Carlyle, Prologis, Morgan, Freddie. I mean, recognizable names. It's their best-in-class funds that we work with. So it's a multi-strategy, multi-manager, and multi-sector approach. Now, the last part there, the third box, is simply looking at all the various kind of cornerstones, if you will, in real estate. We tactically manage across all of those. I mean, again, very easily we can add into some and pull out of others and allocate appropriately, not only to where the world is now, but where the world is going to. And that's actually, when I joined the firm, I was very big on us kind of showing what we do, show our work, if you will. If we're having kids, that, it's like, show how you got to that math answer at the end. You can't just put the number. So I was very big on asking us to show our work, and so we do. And that'll be one of the future slides here. To get into this business and to work in the institutional world, you really have got to partner up, in our opinion, with the biggest and the best out there. And that's what we did. We did extensive amount of interviewing 11, 12 years ago, and they were able to, and I'm very proud of BlueRock, it was before me, but it's pretty incredible that they were able to get them, was Mercer. So Mercer manages the private equity sleeve of our portfolio, and a company called DWS, Deutsche Reef, they work on the publicly traded side. It's obviously very small portion of the portfolio, but the big part is Mercer. Mercer is the world's largest asset advisor, and there isn't even a close second. To give you a sense in size and scale, they have 17 trillion that they manage. Trillion, not billion, not trillion that they manage. So what that means is that when a pension like a CalPERS, an endowment like a Harvard or Yale, or an institutional investor like a CalSTRS is looking to get access to the private equity world, they work with an advisor, kind of like you guys work with Kelly. They work with an advisor, and the advisor would be Mercer. Okay, to give you also a sense again on size and scale, if you cut them in half, they are still almost twice the size of number two. Cut them in half, and they're almost twice the size of number two. That's, in my opinion, who I want on that. I want to be on the same side of the negotiation table as Mercer. So they are just incredible. 76-year history, 20,000. This is one bullet point that I talk about all the time. 20,000 employees in 130 countries. Within the first 2 weeks of because by the way, what happens internationally affects us domestically, whether we like it or not, right? Within the first 2 weeks of COVID, we were on with some of the biggest landlords in Wuhan. Why? Because we leveraged 20,000 employees with boots on the ground in 130 countries to get a sense of what's going on in the world. So again, having that sort of prowess in those people is crucial. This is tough to read, and those virtually may be able to see it a little bit better. But for those of you in the room, this is simply the roll call, if you will, of all the various companies that we work with, their specific funds. The minimum here in the center that I think is crucial to point to. I don't know if you can see that on the Zoom. Yeah, you can. In the middle here, that is the typical minimum investment that it takes to get in each one of these funds. That is also part of your fact sheet that's in front of you for those that are here. I did include that. And then on the far right, on inception year, that's crucial as well to show, in the sense that these aren't new funds. That's important to look at. Some of these funds have been around since the late and early 70s, 80s, 90s. These are deep-rooted, evergreen strategies. It would take a heck of a lot more than a strong windstorm to affect any of these, that's for sure. So you got a 7,000 property portfolio, 385 billion of assets, and at a great occupancy level in the low to mid 90s. Which is great. Here are some of the other companies, like I talked about earlier, that also invest in these same strategies. Allstate, Blue Cross, CalPERS, CalSTRS, NYSTRS, Orange County Employees Retirement System. Where's some of the other big ones? LA Fire and Police. I mean, all of these investors work and invest in the institutional private equity world. So you're, in other words, kind of marrying yourself with the others that do the same. Here's the set. So geographic diversification, I'm not as concerned on, but it is something that we do like to show. We are very well diversified across each part of the country. This is the big part, the underlying sector allocation. So let's quickly break down each one of these asset classes and for have you understand what demand drivers are really causing these asset classes to see what the performance that they have. And then one of the future slides here is where are we going to, and what's going to cause us to see the next leg up in commercial real estate, right? We saw incredible growth through COVID. Lately, you've seen a little bit of a pullback just because we kind of shot up a little too quickly. So we're kind of coming back to reality a little bit. And then we think the next leg up is going to happen here very shortly. So industrial real estate is our largest holding. That's a sector that we've allocated to continuously, and we've been growing it since 2015 to become the largest portion of our portfolio. We actually just released today the current numbers, a little bit updated numbers, so I'll go over those with you. Industrial is now 43% of our portfolio. So went from 41 last quarter to 43 now. Industrial real estate would be manufacturing, distribution, warehouses, logistics centers. You know, when you go on Amazon, you say, I want it now or next day. It's got to be held somewhere to do it. So having those assets available is something that we've seen aggressive growth in industrial real estate in a very short manner of time. Pre-COVID, consumer spending online was a fraction of our spending. Now it's about what, 18 to 20%, something like that, of our consumer spending is just e-commerce. We need over 2 billion square feet of industrial real estate over the next 2 to 3 years just to keep pace with e-commerce. I don't know about you, but look around Santa Barbara. Where are you going to build 2 billion square feet? You ain't. So that's where, if you own an industrial property, the opportunity that you have in increasing rents just because of basic supply and demand, and we know it's expensive to build, is just crazy. So I actually had an investor that bought into the Total Income Plus fund, actually right before it saw a little bit of its pullback, and I was on a call with this individual, and he let me know that he's a big industrial real estate owner and sold the building to one of our, it's not in the fund, but one of the managers that's on here, institutional managers, bought the property from him. He bought it, I want to say he's somewhere in the under 10 million and sold it for about 40 million a few years later, all cash to that company. And he goes, the problem I have right now is I can't find anything to buy. I'm looking coast to coast for an industrial property. I can't find anything. And the stuff that I have found that to rent, they're just asking egregious terms. Like, it's not even normal. And so, and if I do find something I like, then somebody else is coming right behind me and taking it for even more than what I thought was egregious. And that's just where we're at now. So industrial real estate, the demand factors are significant. Retail companies as well. They've actually, a lot of them have shifted because of COVID to where not only do they maybe have a storefront, but they're also doing online. Or there's companies like RH and some of these others, restoration hardware, and like Peloton. When you walk into Peloton, you don't walk out of the Peloton, right? You go there, you touch it, you feel it. You don't get the RH couch. You don't get it. You know, you go in, you touch, you feel, you go, wow, this is great. And then they ship it to you. Well, you got to have a distribution facility, you got to have a warehouse. A lot of times when you do buy online, it doesn't go from the one warehouse straight to your home. It can hit 12 different distribution facilities before it gets to your home. So you've got to have these sort of facilities available. So industrial real estate, showing for the next 5 years, is actually going to have the highest growth projections out of all asset classes. 27% currently right now of our portfolio is in high-end apartment complexes. These are renters that are six-figure income earners. They're there because they want to be there, and they want to be there. They don't have to be there. It's kind of they don't need to, but they want to. And these are places that have all the accoutrement you could think of. They've got, I call it the 3 Ps. They got, Pilates and Pelotons and pools and fire pits and walk-in closets and their own office and their own washer dryer. So they're not getting coughed on when they're trying to, put quarters in the machine. They got their own thing there. They've got business centers. They've got everything. And it is gorgeous, some of these places. So they are very, very nice. And they're in areas typically more in the smile states. So if you're thinking, the cursor just to show individuals online, if you create a mouth on the country, kind of on the southern part there of the country is typically where apartments are being purchased. And again, these are very high-end facilities, sometimes adjacent to or downtown or adjacent to like a major attraction. It would be like building building an entire complex right here off State, like where Paseo is or something, something like that, where you're like right in the heart of it, where Nordstrom's and Macy's and all this, right there, you got everything. I can walk on State everywhere. I'm, kind of on the central part of Lower State, and you can get everywhere very quickly walking. And that's kind of the most opportune place you'd want to be, right? And so that's where actually there's a decent amount of building in Upper State for stuff like that too. So it's just a very attractive way to think about individuals that did not buy a home in that sub-3 environment for rates. They ain't doing it now at 8, right? And so you get to the point of, okay, do I want to rent in Santa Barbara, so at least I'm here, or do I have to move 3 hours out so I can find a property somewhere, right, in the middle of nowhere? Well, I don't want to stay in Santa Barbara, right? So I'm just going to rent. And so apartments and what they call single family rental homes, so homes that are single family homes for rent, those are extremely attractive right now, and the rental rates are just going up. And you're going to find, I wouldn't be surprised, let's just say, I spend a lot of my wife's client, one of her clients is a realtor who actually got us our home in Costa Mesa, Newport area. And looking at when rates start to come down into like the 5, 6 area, don't be surprised for the next leg up in residential. Because you've got a lot of people right now sitting on the sidelines that missed out, but they don't want to pay in the 8s. So they're waiting to the 5s and 6s, and then they're talking about a whole new wave. So where's a starter home now? There ain't a thing of starter home. There isn't. I mean, not that I know of. I mean, look at the neighborhoods that we live in. I look back when you bought a phenomenal time in an area called Eastside Costa Mesa, right on the border of Newport, and it was sleepy before. Now it is a booming, and there's no starter home in that area anymore, really. So it's just gotten priced out. So, and that used to be an area that you could get a starter home at one point. So it definitely ain't now. So apartments and single family rental homes are thriving. Life sciences and specialty sectors. Life science, we used to bundle it under specialty. Life sciences now, I want to say it's 15 or 16%. 15 or 16, and then specialty is 8 or 9. So still, but these are like labs, research facilities, R&D facilities for major healthcare and pharma type companies. They are built to suit. So my wife's mom is a scientist. She worked for over 30 years, both in Moscow and in Michigan, in a clean room, N95 mask, like, the Homer Simpson kind of white top to bottom. She worked in that her whole life. And it was, other than when they moved, obviously, to the States, in Michigan, she only worked out of really one property her whole career, other than obviously over there, a different property. But in Michigan, one that was it. And why? Because you couldn't theoretically move a life science company in here. You can't do it. You don't have the special waste disposal. You don't have the special duct work. You can't have clean room capabilities. You can't have this. We've got toxic materials. You got people at, the area right across the street there having wine and getting toxic material. They can't have that. So there's so these facilities are built for that one company, and it is catered to everything that they need. So think about that. When you got a custom building like that, the company ain't going anywhere. Where are they going to go? Right? They built it just for them. Now, if they get taken over, they're still going to stay there. What, are they going to build a whole new facility just for them? No, the company just buys them out and then they continue to operate. So it is a great strategy. We feel we have one of the best, if actually the best, portfolio in life sciences of anybody and everybody out there. So from a competitor standpoint, and specialty sectors would be like senior housing, student housing, single family rental homes, self-storage, data centers, processing all the things that we do. Now, office and retail, office is 5% right now and retail's 1%. It's going to be I want to say impossible, but pretty close to impossible to eliminate completely an asset class like office and retail out of a portfolio. Pre-COVID, and a lot of people backseat drive it now, and I'm like, oh, you should have seen it coming. But office and retail was one of the most office was the most highly transacted property type in commercial real estate pre-COVID. It's a phenomenal strategy. Now, we actually started pulling out of office and retail back in 2015, 2016, 2017. We wanted to allocate more into industrial and specialty sectors, which is what we did. So we were able to pull it back dramatically over the years. We had pretty de minimis in both those asset classes. But where we're at right now is in office and retail, it was a term I spent about 3 hours the other week with our chief investment officer, and he said a term that I love, and I've been using it ever since, is we are under demolished. Under demolished. And I was like, well, can you expand on that? What that mean? You know, what you're talking about? And he goes, the problem that we have right now, let's just say in office, is that a lot of these buildings are just old. And if they're not occupied, just get rid of them. It's too expensive to do any sort of reno on these properties, because it gets to the point where it's not like an apartment complex. So what I could do with an apartment complex is go in, take it over, spend, say it's like an old C type property. What I would do is I'd go in, I'd gut it, redo the piping, spend about 10 grand a door. I put in all new floors, all new appliances, scrape the ceiling, paint the walls, put in the granite countertops, and you systematize it, if you will. You'd have everything kind of like cookies. You could order, you know, 300 of this, 300 of that. I mean, you're kind of ordering all the same things, so you get mass discounts, and then you have it all. And once you've done a couple, you know, you can very quickly finish the rest. So, anyways, you knock all that, you paint the outside of the building gray. It's now new. You replaster the pool to a dark color and kind of restain the concrete, and you can jack up the rents and call it Class A renovating. Can't do that in office. You just can't. It's too expensive. And a lot of these office buildings are old, and they got outdated elevator shafts, and they're not OSHA compliant. You know, all of these issues. The windows are too small, and you don't have good ventilation, and it's just too expensive to do anything. So you get to the point that you gut it, or excuse me, you demolish it. Same thing with retail, indoor malls. Same concept. Indoor malls are just getting slaughtered. Now, outdoor malls, there's a number of outdoor malls, like where we live. Go to Fashion Island on a Tuesday. Crazy. Go, and I mean, most outdoor malls are just thriving right now. People are walking their COVID puppies. They're excited to be out. They're out doing things. They're eating at the restaurants, having a glass of wine hopefully when it's appropriate. You know, they're out doing things and shopping. Indoor malls have struggled. And so they're having to demolish them and repurpose them. And like, actually, if you went south and you go down to like a Woodland Hills, they have a great outdoor mall, but right next door it was an indoor mall that's now getting demolished because they couldn't. Do you know what I'm talking about right there? The Westfield on Topanga. So because they're struggling, and actually the Rams bought out that area, and they're going to do a whole crazy situation there. But that's what's happened. So go to the outdoor mall, literally right next door, killing it. Restaurants killing it. Everything there is awesome. Right there where the indoor mall is, where it's like the Sears and the JC Penney's and all these things, just there's something there. Nobody would want to go. I mean, I don't even know how that PF Chang's or whatever it is right there is even still open, but it's just it's getting demolished. So, and that's really what's happening. And then an interesting part about it, and by the way, retail also encompasses Costco, Walmart, Target, CVS, Rite Aid, grocery stores, all these things. So you got to realize that there are asset strategies, even in retail, that are still doing well. So the problem with office, and I'll leave on, this is the last one. What's interesting too, is that there are certain segments of office that are actually doing well, and nobody talks about it. So don't listen to the talking heads on CNBC that pay to be there, by the way. A lot of them just don't know these things. They're not in the business. In office, because they're always talking about commercial real estate this, commercial real estate that, what they mean is office. There are certain parts of office, though, that are actually doing well, like very high-end A office. So what's happening is say they had a huge space, a company, when they've only got 25% coming in on Monday and 25% Tuesday, 25% Wednesday, they don't need 100% of their space, 25% of it. So they're getting rid of that older office space that they had. They're moving into the Class A, but only taking 25% of the space. So like if we're going to get people to even show up, we might as well have a nice office. And that's how they're doing it. So here's the tactical management that we talked about. We've added into apartments, added in aggressively over the years into industrial, pulled out of office and retail, and added aggressively, very aggressively, into specialty sectors. So this is what's going to drive the next leg up. This is showing that on average, here's the income growth in these strategies, and here's where it's going to be for the next 5 years. So there's just great growth projections, and that's where we feel the next leg up can come in real estate. Here's the run that we've had. It's just been straight bull, came through COVID, very positive, very, very positive on the upside. And here's the pullback that I talked about. And we feel it's been settling nicely. The predominant portion of the drawdown happened in 2 months. You've been a average total return of 7.82 since inception annually, going on 11 years now. Here's the income, like I talked about, at top 5.25, with 2/3 of it, 65% on average, historically tax deferred on a 1099 basis. But I talked about that. Here's the performance. Only a handful of times ever since inception have we ever had a down year. Annually, here we are on the far right. This is detailed information. This is something that I spend a considerable amount of time on with Kelly. This is where the money's earned. It's really spending time deep diving on risk adjusted returns and all the different metrics to look at versus stocks and bonds and publicly traded funds. And in every single instance, we're a clear outperformer. Again, up in that top left, exactly where you want to be, up in Seattle. And then lastly, I'm not going to go over this completely. This is simply talking about looking at all funds out there. There's almost 6,000 of them. In every single instance, compared to the averages, we are considerably outperforming. And in certain instances, like in green, we're actually the #1 fund out of all almost 6,000. So, which is pretty impressive. And then structurally, we have it as a mutual fund. The big thing is that we are a continuous offering, continually raising capital. We have liquidity on a quarterly basis. There's a potential that you could have a proration, meaning you only get a portion out, but we have to provide liquidity quarterly. We can't shut that down. We price daily, so you know exactly what's going on. And then again, we really like this particular structure just because of the fact that we can have up to 95% of our holdings in private funds or semi-liquid. Whereas if we did it in a more common way called an open-ended fund, you can only have 15%. So it's very limited. We really like that institutional private equity strategy. And I think with all the reasons that we talked about, you know why. So anyways, I want to thank you guys for listening, some familiar faces as well. So it's great to see you guys. And thank you, Kelly.
Stay here, stay here,
Oh.
stay here. Go back.
Thank you, guys.
Go back to your total return slide. I want to bring this to the attention of everyone. Yeah, there you go. Okay, so as stay here, Jason, because we have questions.
Oh,
So we got to answer those. Okay, I want you to notice this because this slide, of course, is over their full time, 2012, that when it started?
yeah, 2012, October of 2012,
Okay.
October 22nd to be exact.
Okay, there you go. Okay, you see ups and downs, but it's pretty smooth for the most part. We've had COVID hit us. We had 2008, we had COVID. We've had last year that wasn't a great year for the stock market in general. So yes, we see a downturn. And I say this to people that I meet with all the time. This is a marathon. This is not a sprint. So some of you in the room, some of you on the Zoom, I know, I put into this program probably towards the end of last year, and we did have some downturns. So we had the price come down a little bit, not huge amounts, but down a little bit. The dividend has stayed the same. They've continued to pay that. They have no intention of not paying that. It's again, largely tax advantage, which is really good. But this is a long-term investment. This is not a 1-month investment, even a 6-month investment. This is a 2-year, 5-year, 10-year type of investment. And if you stay in it all of that period of time, you'll probably do okay based on their history here. And in my opinion, real estate is a good place to be. So you got to be patient. And that's true with any investment I recommend for anyone really out there. This is a marathon. I can't say that enough. This is not a 1-month.
Bill for us.
Yep, I know. We need to give patience pills sometimes to people. I will mention here, because I talked this on my radio show recently. Panic is not a strategy. When you see the market go down, and even in something conservative like BlueRock here, and it goes down a little bit, and oh, I'm panicked, the market's down, oh, let's liquidate. That's not a strategy. That's not what I do. I'm a long-term investment advisor. I'm a conservative investment advisor too. I typically don't take a lot of risk with people. So stay invested. Keep with your plan. If there's anything wrong with an investment, I will tell you to get out of it. There is nothing wrong with BlueRock. Long-term investments. I think it's a great dividend play. It's a great slow growth play. It's not a risky investment. It's, if you remember my master proprietary process I showed earlier, it's not in the red because the red goes up and down like Jason's slide showed earlier. A lot of volatility with that. We're not looking at something like that for BlueRock. Yes, it's going to go up and down as proven by their chart here. Expect that. Expect things to go up and down. But long-term is what we're looking at here. Okay, we have questions from the people in the room as well as our Zoom listeners too. So the first one here, Jason, come over here with me. So property of vacant shopping centers, does that going to work to redevelop for industrial space?
Potentially, yeah. So you would just completely demolish the facility And it would just be a matter of whether they could get it zoned appropriately. So, I mean, pretty simple. So yeah, actually what they're talking about now as well is that you're going to have a kind of a multi-strategy in one. So you could maybe theoretically have like retail and shops on the bottom and then industrial on top.
Yeah, I noticed.
Something of
they
that
do
sort.
that-
They do a lot.
they
Mixed
do that-
use, excuse me.
Mixed use, yeah, they do that a lot in New York and LA and
Right.
those kind of places.
Right.
They have retail on the bottom and then apartments up top.
Yep.
Okay,
So much of that went on just south of the John Wayne Airport or all the
Correct.
commercial buildings.
okay, the Zoom people can't hear you, Al.
Now
So
they're
let's
all-
wait, let's wait. The Zoom people can't hear you when you speak.
Yeah,
That's
they're just
great.
talking about, there's plenty of areas doing it. One area, like I'll be in next week in Las Vegas, tremendous industrial development out there. I don't know if you guys have been to Vegas anytime recently. I've been going every month for about 15 years and it is unbelievable. The development out there in industrial real estate is
Yeah.
breathtaking.
Here's a question. Where do you see interest rates going for real estate in the next year?
Oh, man. I think, that's a good question. I think actually, if you look at some of the minutes and actually Powell just spoke today, I think you're going to find, at least what he indicated, is that he's kind of done on increasing rates. And I think you may have heard similar, right? So it looks like they're done pushing up rates. And so I think the rates will stay high for a little bit longer, for a while longer is what they're thinking. And then from there, they'll start to work it down. I don't foresee that happening right away. They did indicate that he's done putting pressure on the system. They want to keep it higher for longer, for a little while, and then work its way back down. When that'll be, I don't think it'll be next year. I think it'll be a little bit.
Do you own any real estate outside of the USA?
No, domestic only.
Okay.
Buying internationally is a fickle beast. We've done it before. I've done it before in my past, and it's not easy.
So what's the dividend for this fund?
5.25 has been for 11 years now, unfazed
Good. Okay, I think we'll end
with
it there.
tax efficiency.
Thank you, Jason.
Yeah.
I appreciate it. I have a few more slides for those of you on Zoom here and in the room. Let me go there.
What's the minimum?
$2,500.
Okay, good question. Just came in through the room. What's the minimum investment to this? It's $2,500. And you can invest this in IRAs as well as outside of IRAs as well. I do a lot of this in IRAs as well, because I like the conservative nature of it. So anyway, thank you, Jason. I really appreciate it. Really appreciate his insight here. I think it was a nice deep dive into institutional real estate, which we don't have access to unless you're a buyer of $10 million per pop. And so most of us are not. So it's a great way to get involved in that. Okay. Again, thank you for your input here. I know we have questions. If I don't answer your question, it's because I either think we need to answer it offline, which might be a better for you. I know there's a couple of people in the room that had some questions, so we'll answer those offline for you. Upcoming events, I do have a number of upcoming here. Pay attention to California Wealth Advisors on my events page. That will talk about different seminars I have. I have product specific seminars as well as general educational types of seminars available to you. So just check my website for any ones that are those coming up. This one I have coming up on December 5th. This will be on traditional investments, as I mentioned earlier, stocks, bonds, mutual funds, and annuities. Do a deep dive in all of those. So sign up for that one. For those of you new to me, I like that first meeting to be in person. I want to get to know you. I want to find out what you're looking for, and if I can bring to the table what you're looking for. I can do Zoom meetings and phone calls too, but I prefer the in-person meetings. And I do have an office space in Anaheim that I use, as well as my Santa Barbara space too. So with that, I want to thank you all very much. I appreciate you guys coming. Hopefully it was educational for you, and we will talk with you all soon. Bye-bye.